Good morning to all. Now I am going to discuss mock test paper series 1 November 2024 for CA intermediate portion. Let us start. Cost and management accounting, sir. Part 1. Case scenario based MCQs is the case scenario 1. So this question is related to standard costing, sir. So here two paragraphs given in the problem. So here tabulated information main important. See the tabular data, budget information and actual data. Units produced 10,000 units, but actually produced 9,500 units, sir. Therefore, unutilized volume equal to 500 units. Fixed overheads amount 20 lakhs. Actual fixed overhead cost incurred 19 lakhs 50 plus additionally incurred 1 lakh. So, total 20 lakhs 50,000. Next, budget hours, sir, 15,000 hours. Actual working hours 14,250. So, here one important point, budget output 10,000 units, sir. Budget hours 15,000 hours. Therefore, standard time allowed for 1 unit equal to 15,000 hours divided by 10,000. 1.5 hours, sir. Standard time for 1 unit is equal to 1.5 hours. So here 9,500 units required time equal to 9,500 into 1.5 hours. 9,500 units into 1.5 hours is equal to 14,250 hours, sir. Actual working time equal to 14,250 hours, sir. Therefore, efficiency ratio 0. Therefore, efficiency variance nil. So, this is the technique. Next, variable overhead rates, sir, 50 rupees per hour. So, therefore, budget VOH cost equal to 50 into 15,000. 50 into 15,000. So, that is the 7 lakhs 50,000. Next, actual VOH cost, sir, for 10,000 hours rate 50 rupees, that is 50 into 10,000 hours. 10,000 into 50, so that is 5 lakhs plus 60 into additional hours, sir. Here additional hours is 4,250 hours. 4,250 into 60, that is equal to 2,55,000. Total 7,55,000, sir. Total 7,55,000. 7,55,000. Now you can easily calculate given MCQs. Let us start one by one. So, what is the fixed overhead cost variance for XYZ company, manufacturing company in May 2024? So, here fixed overhead variances can be done either output basis or hours basis. Output basis dead easy, sir. Suppose here actual output is 9,500 units. Rate per unit equal to, that is the fixed overhead rate per unit equal to 20 lakhs divided by 10,000 20 lakhs, sir. 20 lakhs divided by 10,000. That is 200 rupees, sir. So 9 absorbed fixed overhead cost 9,500 units into 200. 9,500 units into 200. So that is 19 lakhs. This work should be completed in 19 lakhs, but actually incurred, sir. But actually incurred 20 lakhs 50. Therefore, answer is 1 lakh 50, sir. See the suggested answer. Here answer is 1 lakh 50. Here answer is 1 lakh 50. Next, the second question, sir. Fixed overhead volume variance. Here clearly mention unutilized volume 500 units, sir, into rate per unit 200, sir. 500 into 200, sir. 500 into 200. 1 lakh, sir. 1 lakh adverse. See the suggested answer, sir. 1 lakh adverse. Next. Sir, efficiency variance. Here, standard hours equal to actual working hours. Therefore, efficiency ratio is 100. If the efficiency ratio is 100, efficiency variance 0, sir. See the answer. Next. Next one, sir. Next one. What is the VOH expenditure variance? It is the deviation between previous rate and actual rate of paid hours. Here paid hours and working hours both are same. So here paid hours denoted by AH. Here actual working hours are 14,250. 14,250 into 50 rupees. Previous rate. 14,250 into 50 rupees. Minus paid hours into here, that is the actual VOH cost incurred 7 lakhs 55,000, sir. So 14,250 into 50, 7 lakhs 12,500 minus 7 lakhs 55,000. 42,500 adverse, sir. See the suggested answer. Correct answer. Next. FOH expenditure variance, sir. Expenditure variance means budgeted FOH cost minus actual FOH cost. Here budgeted FOH cost 20 lakhs, sir. Actual FOH cost 20 lakhs 50. So that is 50,000 adverse, sir. 50,000 adverse. Yes. 50,000 adverse. So scenario based question completed, sir. Just 8 minutes, sir. So apply the trick. Just 8 minutes. So for this question, time required only 8 minutes. So as per this experience, standard time for this question is only 8 minutes. Apply the trick. You should apply the trick, sir. Next, case scenario based second question, sir. This is marginal costing, sir. This question is related to marginal costing, sir. Here variable cost details are given. Variable cost details. Company produces product name T-shirts. Material cost variable labor cost. special services. So please collect the variable cost elements. Please collect the variable cost elements. Find out the net variable cost. See the printed solution. So here net variable cost 75,47,750 rupees. So net cash outflow due to export order 75,47,750, sir. Right? Next, fixed cost elements collected, sir, and calculate the fixed cost. Next, sales directly given. Please collect the sales amount. So here company is able to sell 80,000 t-shirts each year. He is currently working at 80% of his total capacity. So spare capacity is 20%. After searching for potential customer in US, because received an inquiry for 30,000 units from a wholesale distributor in California. As per the inquiry, order will be placed if price per t-shirt is reasonable and the order has to be satisfied in full. Right? So here company having a spare capacity, sir. So after searching a potential customer in US, Vikas received an inquiry for 30,000 units from wholesale distributor in California. Next, Vikas decided to send a quote and the order was placed by the foreign client on the same day. Okay, right. So this foreign order also required a special packaging. Okay, it is spent at 20% of the total prime cost per t-shirt. Prime cost means material cost plus wage cost plus direct expenses. Here there is no information about the direct expenses. Okay, next. The production was done quickly and foreign consignment was transported to custom port via service from a carriage agency. It charged 80,000 rupees for one truck whose capacity was 500 kgs to transport whole of the consignment. Truck was 20% vacant after loading the consignment. So these details please read thoroughly, sir. So calculate the final variable cost, fixed cost, sales. Then you can easily answer the questions. So here calculate net cash outflow due to this export order. So please collect the variable elements and expenses incurred at the time of export order. So add them, we'll get the answer. So here clearly mentioned, that is 75,47,750. Next, what would have been the minimum price that Vikas could have quoted per t-shirt in US dollar? So here exchange rate on 1st June, $1 equal to 83.86 rupees. So first of all calculate in rupees, then divided with 83.86, then answer will be in dollars. So here see the solution, sir. So here minimum price, variable cost net amount, fixed cost loss of profit, that is the minimum price. So first we have to calculate minimum price, then divided with the volume, we'll get the minimum price per unit. Then conversion, then convert into dollars. $1 equal to 83.3864. So answer will be $4.23, sir. $4.23. Next to C. So 7th question completed, sir. 8th question. Payment from foreign client was received on 8th October when exchange rate was 86 rupees. Sir, on October 8th, dollar rate equal to $1 equal to 86 rupees. Calculate the profit earned from this export order. If actual quoted price was $4.90 per t-shirt, select the correct amongst the following. So then calculate the profit, sir. So generally profit equal to sales minus variable cost, you get contribution less fixed cost, will get profit. Here sales 30,000 shirts into $4.9, then we'll get dollars amount, into 86, then we'll get rupees, less variable cost already in rupees, deduct, then we'll get contribution less fixed cost 11 lakhs, then we get the profit. This is the 8th bit, sir. C answer. Next, what is the net cash inflow from the export order? So cash inflow means sales less variable cost, then we'll get the cash inflow. So here sales volume 30,000 units into 4.90, here price, selling price expressed in dollars. So first of all calculate sales revenue in dollars, then multiply with the dollar rate in rupees 86, then we'll get to total sales revenue in rupees less variable cost, we'll get the cash inflow. Cash inflow. So here answer is 50 lakhs 94,250 rupees, sir. Next, what is the incremental benefit from this export order? So incremental benefit means sales less variable cost less allotted fixed cost less loss of profit, that is also considered. So that is the incremental benefit equal to 19 lakhs 94,250. Sometimes sales revenue at the Indian price, at the domestic market, sales price at the foreign market, take the incremental revenue, then will less variable cost will get the incremental benefit. That is another alternative way. So here sales 30,000 units into 4.9 into 86, less variable cost less allotted fixed cost less loss of profit, incremental benefit equal to 19 lakhs 94,250 rupees, sir. So this is the marginal costing, sir. So total 10 bits completed, sir. 11th question, sir, related to employee turnover concept, sir. That is employee cost chapter name. So question related to employee cost, sir. So concept labor turnover, sir. The rate of change in the composition of employee force over the average number of employees for the year is computed 9% under separation method. LTR under separation method 9%. Next, however, the same rate is computed as 15%, 30% under the replacement method and flux method. Flux method means there is flux 2. Consider the average number of employees on roll during the year as 200 rupees, 200 workers, sir. Sorry, 200 workers. Considering the average number of employees on roll during the year as 200 workers. That is the average number of workers directly given 200 workers. Find out the number of employees. Find out the number of employees. Replaced one, left and discharged second one, recruited and joined. So 3 questions. So replaced, sir. How to find the replaced number of replacements? How to find the number of left and discharged? That is the number of separations. Next, recruit and joins means total recruited or total joinings. Now, here one by one, under separation, sir, 9%. Number of separations we need to find divided by average number of workers. Average number of workers 200 is equal to 0.9% means 9 divided by 100, 0.09. So cross multiplication 200 into 0.09 is equal to 180. So 180 left and discharge. Next 15% replacement, set 15 divided by 100, that is 0.15 into 200, that is 30 replacements. Next, recruit and join, that is the total joining, sir. So under flux method, formula number of separations, number of replacements plus number of recruits X divided by 200 equal to 0.3. So 20 into 0.3, 20 into 0.3, 6 sir. So 180, sir, not 20 sir, 200 sir, 200 into 0.3, 60 sir. So 60, x equal to 180 plus 30 minus 60, answer 150. So 30, 180, 150 sir. Here 30 answer correct sir. Next, this is 200 into 0.15. Okay. 200 into 0.09. 18 sir, not 180. 18, 18, 18, 18. 18 correct answer sir. Next, this is not 150 sir, 18 plus 30 equal to 48 minus 60. Sir, 12 sir answer. Sir, 18 plus 30, 200 into 30%, 0.3, 60. 60 minus 48. Wait. Okay. So this is new recruits sir. New recruits plus replacements 30, that is equal to 42. This is X equal to new recruits, freshers plus replacements 30. So total joinings equal to 12 plus 30 equal to 42. Here questionnaire is asking total joinings. So 12 plus 30 equal to 42. Okay. So this is the employee turnover sir. Next 12th question. Which of the following items is not the cause of difference in financial and cost accounts? Income tax not treated in cost accounts. This is one cause for the difference of financial and cost books profits. Dividends credited in financial books. This is also one cause of difference in financial and cost books. Loss on the sale of investments not treated. Not treated sir. This item is not the cause of difference sir. Suppose loss on the sale of investments treated in financial accounts, that is a cause of financial and that is a cause of difference between financial and cost accounts, but it clearly mentioned not treated. So answer is C bit sir. Next 13th. Company is currently operating 60% of its total capacity, which is 1.5 times than the previous year. The total capacity of the company is 2 lakhs units. Other information relating to production is provided below. So here this question is related to marginal costing sir. Break-even point. Break-even point equal to fixed cost divided by contribution per unit. Contribution per unit equal to selling price per unit minus variable cost per unit. Here selling price per unit given in the problem, variable cost per unit given in the problem, apply the values, sir. So fixed cost divided by contribution per unit. So here contribution per unit, selling price per unit 52, variable cost per unit 36.4. So final answer 1 lakh units. 14th question. This is service costing sector, life insurance companies. So in life insurance companies, classification of expenses, 4 categories: marketing and sales expenditure, operations expenditure, next IT cost, next functional expenses. So claim management cost, facilities cost, employees cost. So here please segregate the expenses, sir. What they are asking this question: marketing and sales supporting cost, operation cost, IT cost, supportive functions cost. Marketing and sales supporting cost, sir. Policy development cost, policy development cost. Next, marketing the policy, cost of marketing of the policy, sales support expenses. This is 1, this is 2, this is 3. These 3 related to marketing and sales supporting expenses. So add these 3, sir. Next, second one, operations cost. Operations cost includes policy issuance cost, policy servicing cost, next claims management cost, A plus B plus C, that is second one. Next, IT cost, that is directly given 30 lakhs 307 lakhs 19,000, sir. Sorry, 3,071 lakhs 90,000, sir. IT cost. Remaining all related to support functions cost. Related to support functions cost. See the printed solution. Suggested answer, sir. So here policy development, cost marketing, sales support, okay. Operations, policy issuance, policy servicing, claims management, IT cost, remaining all supportive functions cost. Okay. So answer 14C, sir. Next, the last question, sir, in part 1. So this question related to joint and byproduct, sir. Here questioner is asking find the amount of joint product cost to be allocated to P2 by using the physical volume method. So here company introduced an input at separation point 2 main products and 1 byproduct, sir. 2 main products and 1 byproduct, sir. So here net realizable value of byproduct is treated as a deduction from the joint production cost before the joint costs are allocated to primary products. Okay, these 2 main products are primary products. This is the byproduct. So first of all, calculate the net realizable value of byproduct, then deduct the total joint cost. Will remaining amount shall be apportioned to primary products P1 and P2. So see the printed solution. So here joint cost net realizable value of byproduct, sir. So that is the net realizable value 40, 81,250 case into 40. Remaining joint cost 97 lakhs 50,000, sir. Out of that, certain amount allocated to primary product to P1 and primary product to certain amount allocated to P2. So by physical volume method, sir. So apply the values 65 lakhs and here 65 lakhs, sir. Here questioner is asking only P2, primary product to 65 lakhs, answer A. So this is the part 1 paper, sir. So here standard costing, Very, very important. On marginal costing, very, very important, sir. Okay. Part 2, sir. First question 1A. This is joint and byproduct, sir. Here common raw material item introduced into the process. So at separation point, 3 products produced simultaneously with each having a significant relative sale value. These products known as joint products, sir. So here joint products, gasoline, diesel, heavy fuel oil, sir. Next, here manufacturing cost. Total joint manufacturing cost 15 lakhs, sir. With an additional cost of 7 lakhs 44 incurred for finishing heavy fuel oil. So there were no opening inventories of gasoline, diesel and heavy fuel oil. Though at the end of the period, the following inventories of complete units were available. So here inventory levels were also maintained of each product. So you are required to compute following for gasoline, diesel and heavy fuel oil. Joint cost allocation under net realizable value method. Here important point, NRV equal to total, that is the final sale value of total output, sir. Final sale value of total output minus selling expenses. Here there is no information about the selling expenses, no need to write, minus further processing cost, will get the net realizable value. First of all, we have to calculate net realizable value of each product. Then apportionment of joint costs over the joint products. Okay, next point, here questioner is asking cost of goods sold. So how to calculate cost of goods sold, sir? Simple. First, share in joint cost. Share in joint cost, sir. So here under net realizable value method. Net realizable value method. See the side answer, sir. See this. Final sale value of the total, very, very important, total production. Next, further processing cost. Gasoline is fully processed at separation point. Diesel is fully processed at separation point. But an additional cost incurred only for heavy fuel oil, sir. So this is the net realizable value. Joint cost allocation completed. Okay. So joint cost allocation completed, sir. Now first calculate the cost of production. Share in joint cost, further processing cost, add them, will get the cost of production. Adjust the inventory levels here. Opening inventory nil, closing inventory deducted, then we'll get the cost of goods sold. So see this statement. Allocated joint cost, add additional cost, that is the FPC, add them, we get the cost of production. If there is no opening inventory of finished goods, then cost of production becomes cost of goods available for sale, less closing inventory, then we get the cost of goods sold. Okay. So how to calculate production volume, sir? Simple. Sales in quantity plus closing stock minus opening stock, then we'll get production. Sir. Right. Next question. B-bit, sir. This is cost accounting systems. So this is non-integrated accounting system, sir. The following information have been extracted from the cost records of a manufacturing company. Stores transactions available. Opening inventory of stores account, that is the to balance brought down. Purchases to cost ledger control account. Next, raw material issue to work in progress control account debit to stores ledger control account. Next, returns are stores ledger control account debit to work in progress control account. Issue for repairs sir, that is factory overhead control account debit to stores ledger control account. Next, deficiency found in stock. Here there is no specific information. Is it normal or abnormal? In that case, take the assumption. So my opinion, as per my advice, assume normal sir. That is factory overhead control account debit to stores ledger control account. Some students say, sir, my assumption is abnormal sir. Go for it. That is also correct sir. So you can select any option. Some student says abnormal, some student says normal. In case of normal, entry is factory overhead control account debit to stores ledger control account. In case of abnormal, costing P&L account debit to stores ledger control account. So in this question, see the suggested answer. Sir, here also deficiency assumed as normal. Alternatively, this can be treated as abnormal loss. In that case, entry is costing P&L account debit to stores ledger control account. Have you understood, sir? Right. Next, work in progress, sir. Opening balance, to balance brought down. Next, direct wages charged to wage control account. Overhead charged to overheads control account. Next, closing inventory of work in progress. Okay. So in work in progress control account, what are the transactions involved, sir? Direct material charged to production, direct wages charged to production, direct expenses nil, factory overhead charged to production. Then we get the gross factory cost. To balance brought down, that is the opening inventory of work in progress, less by balance carried on, that is the closing inventory of work in progress. Will get the net factory cost. That is, entry is cost of finished goods. That is the finished goods control account debit to work in progress control account, sir. Yes. Right. So here entire production is sold at a profit of 10% on cost from work in progress station. So here in this case, no need to prepare the finished goods control account. In this case, no need to prepare the admin content, no selling and distribution content. So straight away from work in progress station to costing P&L account. So here question is asking stores ledger control account, work in progress control account, overhead control account, costing P&L account. So simple question, sir. Next. See, this is employee cost. So here calculate the earnings of worker and wholesale scheme under Rowan scheme. So regular problem. Under wholesale scheme, basic wage plus bonus under according to wholesale equal to 50% of the time saved into R. Time saved means standard hours allowed for actual output minus actual working time. Simply says SH minus AH. Next, Rowan scheme, sir. Rowan scheme basic wage plus bonus. According to Rowan, bonus equal to TS by ST into T into R. So here straight problem, sir. Values directly given. So apply the values in the formula. So we'll get the answer. So simple question, sir. So this is the first question. Next, second. So this question related to overheads chapter, sir. So common overhead cost elements given. The company belongs to an automotive industry manufacturing hybrid bicycles. The production of bicycles passes through three departments, namely X1, Y2, Z3. So this is the production departments, and two service departments, QC and M. So here common overhead cost elements are given: rent and rates, general lighting, indirect wages, power, depreciation, machinery, sundries. Definitely additional information provided or department wise information provided. So select the base and distribute these expenses. That is the apportionment of overheads. So your direct wages, sir. Service department direct wages nothing but overheads, sir. Service department overheads and service department direct wages nothing but overheads. So take that these two 12 lakhs and 1 lakh 56. Direct wages of production department, it is a part of prime cost. Okay, not considered, sir. This is the part of prime cost. So only one element, that is the direct wages. So direct wages of service department, it is a overhead. Direct wages of service department M, it is a overhead. Next, common overhead cost elements apportioned to these departments on a suitable base. First, rent and rates, suitable base, sir. Floor space. So take the one by one, sir. Distributed. So primary distribution of overheads to various departments, that is called primary distribution. It includes two steps. One step is allocation of overheads. Second step is apportionment of overheads. After making the primary distribution, we'll get total overhead cost of each department. Then second distribution. So here second distribution, sir. A technical assessment unveiled the following basis for the apportionment of expenses of service departments. So here this is the cross service, sir. Cross service. This is the cross service, sir. So that indicates reciprocal method. So you can do easily second distribution. After that, calculate the overhead rates. These rates are used to charge the overheads for a given works or for a given jobs. So here questioner is asking calculate total cost of bicycle. So metal cost directly given, labor cost directly given, so we'll get prime cost. Next, overheads charged by using the above rates, then we'll get the total cost. Okay, in X1 department 4 hours into rate, in Y2 department 5 hours into rate, in Z3 department 3 hours into rate. So this is the overhead cost problem, sir. Next, B bit. Sir. Okay. B. So this is the batch costing, sir. This question is related to batch costing. You are required to determine the total sale value for 2,400 pence. So here batch size is 2,400, sir. So material cost incurred for a given batch, labor cost incurred for a given batch, will get prime cost. So here batch setup cost also given. Next, overheads also given. So one by one add them, we'll get the total cost. So here batch total cost equal to 19,40,625, sir. Here rate of profit to 25% of sales value converted into on cost, 25 by 75 on cost, that is the 1/3 on cost. 1/3 on cost. So finally sale value of the given batch equal 25,87,500, sir. Next, third one, 3A. Following information is available from the books of YSPP Limited for the current year ending 31st March. So this question related to cost sheet, sir. From the above data, you are required to prepare statement of cost for YSPP Limited for the year ended 31st March showing prime cost, factory cost, cost of production, cost of sales. So please collect the elements one by one. So see the solution, sir. Here material consumed, raw material purchased, freight inwards, then adjust the inventory levels of raw materials, will get the direct material consumed. Next, direct employee cost, wages paid to factory workers. Factory workers means direct workers, that is the productive workers. Payments made to direct workers is nothing but direct wage cost. Next, whatever it may be given to direct workers, that is also included in direct wage cost. That is employer contribution made towards employees PF and employee state insurance. Next, here direct expenses also given, hiring charges, amount paid for power and fuel, amortized cost of moldings, job charges paid to job workers. So add these three, will get the prime cost. Next, factory overheads, lease rent paid for production assets, depreciation on factory buildings, depreciation on plant and machinery, repairs and maintenance paid for plant and machinery, insurance premium paid for plant and machinery, that is the factory assets. Next, insurance premium paid for stock of raw material and work in progress, salary paid to supervisor. So that is the gross factory cost. Adjust the inventory levels of work in progress. Opening should be added, closing should be deducted. Then we get the net factory cost. That is also simply known as factory cost. Next, add quality control cost, sir. Next, research and development cost, sir. Next, admin cost related to production. Then we'll get the cost of production. Sir, before going to cost of production, first search. Here, protective packing information also there. Then add the primary packing cost. Then we'll get the cost of production. Next, adjust the inventory levels of finished goods. Opening should be added, closing should be deducted. We'll get the cost of goods sold. Next, general administrative overheads, selling and distribution overheads. Next, secondary packing cost. Secondary packing cost. Then we'll get the cost of sale. So here, abnormal cost, I mean, one element is very, very important. Demurrage charges is a type of penalty, thus will not form a part of cost. This element is appearing only in financial books, not in cost books. Okay, right. Next, B bit, sir. So this question is related to material cost, sir. So here, material details given, unit price of raw material 80 rupees, ordering cost per order 40 rupees, number of units to be purchased during the year, annual demand of raw material 10,000. Okay, so here cash discount to be received is 2%, that is the pure non-operating income. Next, the annual cost of storage per unit is 5 rupees. Next, the average lead time, maximum lead time, minimum lead time. Here lead time expressed in days, therefore consumption per day is considered. Next, the rate of consumption directly given. So you should calculate reorder level, maximum level, minimum level, danger level. This is without safety stock model. Without safety stock model, sir. Reorder level equal to maximum consumption to maximum lead time. Maximum level equal to ROL plus ROQ minus minimum lead time into minimum consumption. Minimum level equal to ROL minus LTC. Next, danger level, average consumption per day into lead time for emergency purchase. The printed solution, sir. So here important point, unit price of raw material 80 rupees, insurance charges to be paid for protecting goods during transit, that is the at the time of transit insurance charges incurred, this amount also added to purchase price. So finally unit price of raw material equal to 100 rupees. That is important point. Unit price of raw material 100 rupees. So cash discount is treated as a non-operating income, sir. Simply it is ignored. So here reorder level, maximum level, minimum level, danger level. Danger level formulas are average consumption into lead time for emergency purchase. So this is the material cost. Next, fourth question, sir, 4A. This is ABC. So you are required to calculate the cost per unit for each product under traditional method. Under traditional method, all factory overheads, we assume that all factory overheads varies with a single driver. All factory overheads varies with a single driver. So single overhead rate is used to charge the overheads to the product. So in this problem, here single overhead rates are rate 30 rupees. So 360 lakhs. Okay. Here three products. If company produces three types of products, so direct material cost, direct labor cost. Next, production overheads. 10 hours into 30, 18 hours into 30, 14 hours into 30. Therefore, cost per unit. So under absorption costing method, simple procedure. First, select the driver name. In this problem, driver name is direct labor hours. Direct labor hours. Sorry, direct mission hours, sir, not labor hours. Here, mission hours. Sir, here, mission hours. So, presently, company select the driver name is mission hours, sir. Write down the assumption. We assume that total factory overheads varies with direct mission hours, so that mission hour rate is used to charge the overheads to the products. So here rate calculation 30 rupees, sir. 30. Next, here mission hours required for first product 10 hours. 10 hours into 30, 300. Next 18 hours into 30, 540. 14 hours into 30, 420. So this is the absorption costing method. Next, ABC. Under ABC approach, total production overheads can be identified different major activities. Next, cost, assign the driver name. Next, collect the cost driver quantity. Next, cost driver rate. So these rates are used to charge the overheads to the products. Then we'll get the total overhead cost. Okay, so that is the ABC approach. Next, B bit, sir. This is the cash budget. That is the budgetary control. Cash budget, sir. So for 6 months period, so collect the receipts and payments, and you can easily prepare the cash budget. Next, 5A. 5A question, sir. This is process costing. Here, cost incurred in process 1. Given details are related to process 1, sir. Next, degree of completion given. Right. So here you are required to prepare statement of equivalent production cost per equivalent and process 1. Statement of equivalent production cost per unit and process 1. Process 2, sir. Here 2 stages are given. 2 stages are given. Process 1, process 2. Here there is no opening work in progress in the process 1. There is no work in progress in the process 2. So simple problem. So just there is a closing work in progress in 2 process. In case of closing work in progress production statement format, current input less normal loss as per industry norms, less closing work in progress will get the expected output, compare with the actual output will get abnormal loss or gain. So in process 1 there is no abnormal loss, sir. In process 2 there is no abnormal loss, sir. So simple formula, simple problem, sir. Simple problem, sir. Next. Explain the usefulness or suitability of ABC. Suppose in case company produces more than one product, so there is a chance of cost arising, cost distortion is arising, sir. So in case if company produces more than one product, in that case you should use ABC approach. Reason to avoid the cost distortion, that means maybe undercosted or overcosted. That is the main advantage of ABC, sir. Next, sixth question, sir. 6A, this is the introduction to cost and management accounting. Next, 6th B, explain the methods of ascertain the service cost unit, sir. So service costing, sir. Composite units. So that is the weighted average or absolute basis, and the second one is a simple average or commercial basis. Next, C bit, sir. Discuss the many benefits of budgetary control system. It does have its own limitations. Discuss those limitations. Okay, this question related to budgetary control system. Last one is very easy question, sir. This is very easy question. This question is related to introduction to cost and management. Sorry, job costing, sir. 1 minute, sir. Identify the method of costing in the following cases and give one example of industry where this method is followed. Wait. So here this question related to types of costing, sir. This question is related to types of costing. First one is cost of each job is ascertained separately. It is suitable in all cases where work is undertaken on receiving the customer's order. Different customers, so different specifications, so no two jobs are same or no two works are same. So this is related to job costing. Printing press, best example, sir. Interior decoration, automobile workshop, automobile motor workshop, ad agency. These are the best examples. Next, cost of completing each stage of work is ascertained. So cost is ascertained at each stage of production separately. Such type of cost ascertaining program is calling as process costing. Best example, jaggery industry. Next, each group is treated as a unit of cost and thus separately costed. Here cost per unit is determined by dividing the cost of the group by the number of units produced. That is the batch costing. Best example, pharmaceutical industry. A combination of two or more methods of costing. Here product nature is complex. Single method cannot be ascertained. So multiple costing, sir. Multiple costing. See the answer, sir. So first one job costing, correct, printing press. Next one process costing, paper and pulp. Next batch costing, bakery industry, that is pharmaceutical industry also. Next multiple costing by skills. So this is the MTP 1, sir. Okay, all the best.